Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the worlds of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we do post our upcoming live show schedule on aaii.com/webinars, and AAII members do have access to the full archive of shows. I'd like to introduce my colleague, co-host, and co-producer, Kyler Worf, who is AAII's video intern. Welcome, Kyler.
Hi, very excited to be here.
Our guests today for this episode are Derek Hageman, Karen Kamenier, and Matt Bykowski. Today's show has three topics. Is it time to take a look at travel and leisure stocks? In this first segment of this episode of the Individual Investor Show, we're going to review travel and leisure companies that passed the estimate revisions up screen as part of our first cut list. Next, we're going to be speaking to Phoenix Chapter Special Interest Group leader Karen Kamenier about fundamental stock screening for dividend-paying stocks. Finally, AAII finance writer Matt Bykowski walks us through Facebook's privacy checkup and security settings for participating in AAII investing clubs. Kyler will be interviewing some of these guests, as will I. And with that, we're going to go ahead and get started.
Travel and leisure companies were some of the stocks that were most adversely affected by the coronavirus pandemic in 2020. And they subsequently faced substantial declines in consensus earning estimates during the year. Today, I'm joined by Derek, who wrote the article in the AAII May 2021 journal, Leisure Stocks with Signs of Life. So, Derek, why did you first create this cut list? Was travel and leisure on your mind since we've been all more or less at home over the year?
Yeah, hey, Kyler, thanks for having me. Exactly. Yes, I created the First Cuts stock list because travel and leisure has definitely been on my mind since most of us have been sheltered at home for the last year plus. But with vaccination rates increasing, COVID cases declining, and the fact that most people have been cooped up for the last year, it seemed like the timing was definitely appropriate. I think we could all use a vacation after a difficult, isolating year. And personally, I'm more comfortable about traveling, whether it's getting on a plane, staying at a hotel. I'm definitely ready to return to a normal pre-COVID life. And I've actually booked a few trips over the last week, and I'm also looking forward to eating out more, going to live entertainment events again, whether it's to a concert, the theater, or to a sporting event.
How is the market for leisure activities expected to change both short and long term?
Yeah, I mean, you mentioned this at the top, but I think it bears repeating. Travel and leisure companies were some of the stocks that were most adversely affected by the coronavirus pandemic, and they did subsequently face substantial declines in consensus earnings estimates during the year. But the news flow from the travel industry, it is getting better and better, or at least less bad. In April, one of the travel industry's largest global booking services, it's actually on our First Cuts list, Sabre Corp. They announced that their gross air travel and hotel bookings for the spring had significantly improved from first quarter levels. And while air travel, hotel bookings, and restaurant reservations are still well below where they were 1 year ago, they are improving and are at the highest levels since pandemic restrictions were put into place. So you combine that with the latest stimulus package, acceleration of vaccine distribution, and rising vaccination rates. And really, the travel and leisure companies' prospects are definitely starting to brighten, and the travel and leisure industry is definitely strengthening. And you asked about how the market for leisure activities is expected to change. I just wanted to walk through a few examples, and the viewers can really decide for themselves how this may or may not impact the short and long term. But the latest stimulus package, it provides $1,400 to many American consumers, and they may decide to spend some of that money dining out, getting on a plane to visit family, friends, or a new destination. And after a slow start, Vaccine distribution and administrations are accelerating. Since the coronavirus vaccine distribution began in December 2020, over 286 million doses have been administered to people in the US, according to the Centers for Disease Control and Prevention, the CDC. And as of May 24th, almost 164 million Americans, which is about 49.4% of the total population, have received at least one dose of the vaccine, and more than 130 million Americans, which is roughly 39.3% of the total population, are fully vaccinated. One more example, the Transportation Security Administration, TSA, they announced a few weeks ago that US passenger traffic was up, and it's averaging about, well, anywhere between 1.4 and 1.6 million passengers over the period that they analyzed. And this is up over 700% from last year. But unfortunately, it is still down 40% below the 2.3 million average from 2019. And one thing more to add, travel prices are also starting to rise as air travel rebounds. So companies that are principally engaged in the design, production, or distribution of goods or services in the leisure and entertainment industries, they may be worth examining as the recovery accelerates.
Are there any risks involved in investing in this market? If so, what are these risks?
Good question, Kyler. Certainly the travel recovery trend faces ongoing headwinds and setbacks are possible. One thing to watch is how business travel will return now that companies have adjusted to working remotely and conducting meetings online. If business travel doesn't bounce back, that would be a negative for airlines and hotels. As business travel, it's really more of a high margin business than leisure travel. There are a few other possible headwinds. We are seeing coronavirus variants that are appearing in certain parts of the globe that could slow or delay the recovery. And there's also so much pent-up demand for travel and leisure that prices are starting to rise as the economy rebounds. But I would say the risk reward profile for many travel and leisure stocks appears to be shifting in favor of reward. It seems clear that there's plenty of pent up demand for leisure travel. And like I said earlier, I think we could all use a vacation or a fun night out at a restaurant or sporting event after a difficult, isolating year.
On the other side of the coin, there are some potential upsides, some of them you just mentioned, especially since many of these leisure-oriented stocks look forward to reopening soon more broadly around the world. Is there something for investors to consider since some of the companies on this list operate internationally?
Sure. No, good question. For example, if we take a look at the airline industry, it is starting to see some tailwinds, but it may take time for travelers to get back to their pre-pandemic routines. Travel bookings suggest people will be more comfortable traveling by summertime, so that's a good sign. You also asked about what investors should consider since some of the companies on the list operate internationally. Well, I would say in many ways, the US is ahead of the rest of the world in terms of vaccine distribution and availability. And as I mentioned earlier, there are still places where coronavirus cases are rising due to different variants. India, parts of the UK, and Brazil, just to name a few. And many countries still have travel bans for visitors from abroad, or there is still quarantine rules in place if you enter from abroad. So one thing to consider is that the recovery will not be even across the world. It will definitely be lumpy, with some company operations accelerating in certain countries while lagging in others.
COVID will likely have long-lasting effects on our society, especially in how people seek travel and leisure. You spoke about some of the long-term impacts earlier, but do you think investors here should price in this sort of future leisure sentiment when they look for these kinds of stocks?
Yeah, I like to think of it this way. If you remember back early in the pandemic, there was a period when stay-at-home stocks were really popular and rising in price. Well, now stocks related to I'll call them the reopening, which the travel and leisure companies would definitely fall under. I mean, they appear to have some momentum and more focus from investors for many of the reasons that we already discussed. Investors could look at the list of stocks in the first cut stocks list, and especially with the airline, restaurants, and hotels. And really, if you look at a chart from the last year or so, some recovery has already taken place and likely been priced in. But as the pace accelerates, travel and leisure stocks, I still think they may be worth examining.
On the list of companies listed in your article, I noticed restaurants and bars, hotels, motels and cruise lines, casinos and gaming, and recreational products represented roughly equally, but only one company from the airlines and one company from the software industry. Outside of obvious COVID reasons, is there something investors should read into here? Are there any other leisure-oriented industries over the next few years worth thinking about?
Sure. No, good question. And let me just remind our viewers that for this first cut stock list, our starting point was using AAII Stock Investor Pro, and we were looking for travel and leisure companies that have received any upward revisions over the course of the last month in their consensus earning estimates from analysts for the current and next fiscal year. And we screen to make sure that analysts have not lowered estimates for the current or next fiscal year during the past month. So really, I think the list does a good job of capturing, like you said, restaurants and bars, hotels, motels, casinos and gaming, and recreational products. And some of the stocks on the list, we have Winnebago Industries, Darden Restaurants, SkyWest, which is the one airline that you mentioned, and Sabre Corp, which is the software from the software industry that handles a lot of bookings for the industry. I think they really are representative, and they pretty much cover the industries that are going to be worth thinking about over the next few years. Maybe a couple that I would add as people become more comfortable, and as vaccine rates increase, maybe look at cruise lines, car rentals, and movie theaters. I would also add to the list.
Okay. Well, thank you so much for joining us and taking your time. Again, you can find Derek's article, Leisure Stocks with Signs of Life, and many others like it in the AAII Journal. Have a great day.
Thanks, Skylar. Have a great day.
Hello, this is Ryan Ray of AAII again. Programming note here, as some of you may be aware, this is a pre-recorded show, and from time to time, we do have folks come on for interviews. Unfortunately, due to scheduling conflicts, we couldn't make an interview time work for this next segment with Karen Kamenier ahead of the production schedule for this show. So, in lieu of an interview with her, we are going to include some recent remarks from a recent May 15th, 2021 presentation she gave at our Phoenix chapter related to fundamental stock screening for dividend-paying stocks. I just want to note here that, as is the case with all AAII content, this information is intended to educate you to better make your own investing decisions and not for personalized investing advice. Karen here makes some comments regarding sector and dividends, and it's information in this segment that will hopefully help you come to your own conclusions about screening for dividend payers. We apologize for not being able to have her on for an interview. However, I do hope this clip will generate some investing ideas for you, as well as some questions that we can hopefully answer when it comes to fundamental stock screening for dividend-paying stocks in the future. Anyways, we hope you enjoyed this next segment and the rest of the Individual Investor Show.
Barrons, reliable retirement returns. This is taken from an April article with data that was culminated through March 24th. But and I'm going to send all this out. You feel free to look at all of these various prices, dividend yields, market value, 5-year dividend growth rates. and see if there's anything worthwhile or something that causes conviction for one or the other. Just a commentary, in early 1995, a 50-50 stock and bond portfolio yielded a little bit more than 5%. That's above the 4% annual portfolio withdrawal rate that some advisors and investors use as starting framework. That portfolio's yield has fallen to 1.4% at the end of 2020. That is if you sit on a 50-50 stock bond portfolio mix, you're having a yield of only 1.4% at the end of 2020. This is a chart from Valuentum at the end of May. And here again might be some things that you might want to study. Pay attention to the new dividend cushion ratio, the dividend yield, fair value estimate, closing price, and what they're holding as a percentage of their portfolios in the far right here. Not sure about some of these prices. They have, I think, had a pullback since then. Maybe that means you should look at some of those. This was what SPY looked like at the end of Friday, April 30th at 4 in the afternoon. And we've recently experienced some volatility this last week too, didn't we? The S&P 500 index has soared a record 518% since the 2009 lows. Going back, talking a little bit about Microsoft again, they're getting into the healthcare arena. This is the second largest deal ever after buying LinkedIn. They're buying Nuance Communications. This is a pioneer in conversational artificial intelligence. Its technology creates digital transcripts of patient-doctor appointments and automatically adds the doctor's notes to the patient's files. This replaces the process of speaking into a recorder, transcribing the audio, and manually uploading the notes to a file. And I would imagine this is going to have a big impact on the medical transcriber job that'll turn into an old relic. This acquisition gives Microsoft a foot in the door, with most healthcare providers doubling its total addressable market to nearly $500 billion in the healthcare industry. It's also able to sell additional services to Nuance customers like its cloud platform, Microsoft Azure. See this chart for expenditure growth in the healthcare. This is the national healthcare expenditure growth every year. Here we are down here in 21. Bounce, bounce, bounce every year up. Projections of $6+ trillion by 2028. In other tech news, even with part shortages, global sales of PCs, desktops, notebooks, etc., grew 55% year over year in the first quarter of 2021. Worldwide PC sales, Q1 sales, were at 84 million, or an 8% decline due to unfulfilled demand. Sales should grow in part due to the backlog. Business, education, consumer demand is there. They just hope they got the parts to fill the orders. IBM announced a breakthrough in semiconductor design and process with the development of the world's first chip announced with 2 nanosheet technology. The new design is projected to achieve 45% higher performance. We'll see what happens with the IBM pricing. Intel is also putting big bets in the US chip production. We talked about that earlier, but it's also expanding its New Mexico operations and adding $3.5 billion into that facility. That was just announced a week before last. Ford expects the chip shortage to cut $2.5 billion from adjusted pre-tax profit in 2022 and will force it to cut second quarter production in half. So we could see some auto manufacturing layoffs continuing to be announced here for the next months. And we can't go without mentioning banks. Goldman Sachs trading revenue for the first 3 months rose 47%. JP Morgan's trading revenue for the first 3 months of 2021 rose 25%. Morgan Stanley, after losing $900 million due to this Arca-Gas thing, still made $5.8 billion. Morgan Stanley owns E-Trade. So their trades were up by 50% for the first 3 months. So that's the explanation there. Barclays reported first quarter net profit of 1.7, or that's 2.37 billion in our dollars. Total income at its investment banking arm slipped 1%, but equities were up 65%, and their best ever quarter on a comparable basis helped offset the fall. AAII's A+ stock grade summary for major bank stocks. Bank of America, Citigroup, JP Morgan. That's as of 4/20. More than 8 million rental properties across the country are behind on payments by an average of 5,600 according to census data. And these properties seem to be owned by mom and pop folks who depend on that rental income coming in. So now what? It's a wicked conundrum. My activity, this is just some of it. I picked up 5 shares of USB at 54.89 just to open a position, to shake out and add to my bank positions. I bought PAYX in February at 90. I added in April at 93.58. I added a few shares to an existing position of Walgreens. I sold my position of Wheaton Precious Metals to add to my Pfizer. I initiated a buy of 5 shares in Leg to open, 48.90, and I initiated 30 shares of TPG to open. What did I do here? I rolled a call option in Gilead. It was eroded down to 6 cents left. So I kept the premium all but the 6 cents, and I sold it again for 80. So took in 74 cents. I sold a May 41 call in Pfizer. I believe it's over that right now. I have a process of rolling that forward on something that I think is appropriate. Whether the market agrees with me, I don't know, but I have something in play. We'll see what happens. American Steel, once on its knees. This is CNN, May 7th. After bottoming out at $460 last year, U.S. benchmark hot rolled coil steel prices are now sitting at $1,500 a ton, a record high, nearly triple the 20-year average. That's supercharging steel stocks. Nucor has spiked 76% this year. Scarcity and panic are lifting steel prices. But there's somebody out there, Bank of America, who predicts a painful reversal as supply catches up with what she described as unimpressive demand. Steel is just the latest shortage to hit the U.S. economy. We'll see how everything goes there. It's chips, it's lumber, it's chlorine. Everything's in short supply and roiling the markets right now. So we'll see if we can fill that inventory gap. Looking forward, because of the chip shortages, production lines will probably be cut in half. Don't buy still stocks at this time, is basically the recommendation there. Airlines in April, did Mr. Market get ahead of itself? And I haven't looked today, folks. Maybe you have a better idea than I. American Airlines are down 11.6% in the last month. This is like April stuff. LUV, Southwest down 3.5. Delta down 11. United down almost 11. JetBlue down 10%. Spirit down 8%. 42% of independent businesses in March reported having at least one position hard to fill, and they're looking for workers. Auto manufacturers laid off thousands due to supply chain issues, while thousands of service workers returned to employment. And just this week, we now have 18 states that have canceled the extra unemployment money. They're saying, get out there and get a job, folks. Top 20 large cap and small cap free cash flow companies. This is free cash flow. So I want you to be aware of this. Large and small cap, and that's for you to review when you've got time. What's in the card for future growth? This is by sector. All of what I've been talking today has hopefully been highlighting different sectors that you either want to stay away from or look at. This chart, I want you to look at the bottom sectors and then go up and look at the yellow is 3-year, the green is 2022, the light blue is 2021 estimate. The dark blue or black, whatever that is the 2020. So, for example, if you look over here at energy, this was 2020. This is 3-year. This is the 2022 estimate. So we'll see. In the last week, since the start of our recent earnings reports, the Dow Jones Industrial Average gained 2.7, Standard & Poor's up 5.24, NASDAQ 5.4. This is 5-9 stats. And we, like I say, we had some roiling volatility this past week. Domiciled ETFs, they had a net flow of $476 billion, broke a record. So I don't know. The sin businesses are booming. Currently, 16 US states have adopted the legal use of marijuana. Gallup Poll's social survey says 68% of us approve the legalization. 20 states have launched online or retail legal sports betting. So there may be something in there for some of you. I'm not going to get into the mix on this. But will this hurt casinos, or will people go to casinos as well? Governments are rushing to legalize all the sin businesses for revenue after COVID-19 tax revenue slumps for some states, not all. Inflation is here, shortages are here, even chicken. Headline CPI versus core CPI. So is it transitionary, or is this something that's going to be hanging with us? This here, US inflation calculator, that should be live. So when this sends out to you, you will be able to click on that and play with that. So now do your homework. Look at some different stocks that may be in the variety of sectors that may be moving one way or another due to inflation, due to infrastructure build out that may be coming into play. Whatever your thought process are, whether it's chips, whatever, make sure you do your fundamental research, I guess. So I hope this has been a heuristic process that will spur you to further study so you can become an autodidact of the markets and achieve your own personal vision. These are 2 words you're going to have to look up and hopefully continue learning.
Earlier this year, we launched the AAII investment clubs as part of our broader community effort. These Facebook groups allow you to connect with and learn from other individual investors in an online environment. Today, I am joined by the financial writer for AAII, Matt Bykowski. How are you doing today?
Good. How are you doing today, Kyler?
Good. Matt, very good. Matt wrote the article, AAII Groups in Facebook, Setting Your Privacy Options. So Matt, what are some of the advantages that come with using Facebook for group discussions?
Well, I think Facebook's size is its biggest advantage for group discussions. Facebook is prominent around the world, meaning it can link individual investors anywhere. This is key behind AAI's investment clubs. We want to extend our education, information, and research person to person. And Facebook gives us that opportunity. And also because of its size, Facebook offers its services for free. The only cost is your own data, which we'll get into and how to control. And because it's so large, Facebook's not going away anytime soon. So we think it's a good investment to use their group discussion and moderator tools, because it'd be very hard for us to build something of equal quality from the ground up. And it seems like as Facebook's continuing with its business, group discussions and group pages are a larger and larger part of its model.
How can AAII members benefit from the security options offered on Facebook?
I think AI members can benefit on both a macro and a micro scale from the security options and privacy settings that Facebook offers. On a micro scale, I'm talking about controlling the data you're giving Facebook. So, the cost to use the services that I just mentioned. And then also you can control the personal information other users can see. You can tailor your Facebook experience to make it beneficial to you by choosing whose posts and what content you see. You even have some power over which advertisements you receive. So being familiar with Facebook security options allows you to see the potential benefits for its use. Plus, if you're informed about the privacy options you do have, you don't have to live in a perpetual state of fear about precisely who is seeing what with your profile. On a macro scale, if you take the time to go through Facebook's privacy settings, you'll definitely come out a more informed internet user. Facebook seems to recognize that offering education on internet privacy gives users the opportunity to feel more comfortable with the platform. The more you know, the more cognizant of the relationship between user and business you can be. And you can apply what you learn about online privacy from Facebook across the internet.
What is the process of setting up your Facebook security like? Is it quick and easy?
Yeah, so it is both quick and easy. There are several places across Facebook's website to access privacy and security information. To dig into your Facebook privacy, you want to start by finding your profile options when you're logged in. Typically, it's on the right side of your web browser, at least from a desktop. From there, you want to click on Settings and Privacy. If you aren't familiar with online privacy settings, I definitely recommend starting with Facebook's privacy checkup. It groups similar settings under common topics of privacy concern, such as who can see what you share, how people can find you on Facebook, and like I mentioned, your ad preferences. The first topic in the checkup walks you step by step through all of your profile information and posts. Facebook allows you to adjust who is visibility of your profile from here by each topic field. You can customize your audience, and you can even choose only a small group of friends if you want to see specific personal facts. And under the topic of how people can find you on Facebook, you can also even turn off your profile's link to outside search engines, such as Google. So this will block your profile from appearing as a search result for your name if you're concerned about that. And for more background and reading on controlling your privacy and security on Facebook, the The company also offers its privacy shortcuts page, which you can get to at facebook.com/privacy. Facebook's privacy basics can also be accessed through the shortcut learn more about your privacy on Facebook. And here you'll find Facebook's frequently asked questions about privacy answered in simple slideshows of text and graphics. They're really easy to walk through, and at the end of each slideshow, there's a link to the pertinent grouping of the FAQs within the privacy checkout that I was just talking about.
Since we talked a lot about Facebook's privacy settings, I just wanted to ask you about AAII's investment clubs. What topics are covered, and where can people find these groups on Facebook?
Sure. So we have 5 investment clubs focused on income investing, mutual funds and ETFs, stock screening, asset allocation strategies, and retirement withdrawals. You can get to any one of these by going to AAII's Facebook page. You can either search American Association of Individual Investors in Facebook, or just AAII will come up. And then once you're looking at our page, in about the middle of it, there's a row of buttons to click on: home, services, reviews, and shop. More is what you want to click on. It's on the far left. There's a drop-down menu, and from there you want to select groups. From there, you'll be taken to a page with the 5 groups or investment clubs, and you can choose which one you want to enter. You'll be able to see the most recent discussion posts and comments, and you'll also be able to join the group, which you'll have to do to comment. We do moderate the group, so we just want to do a quick check to make sure we know who's coming in.
Amazing. Well, thank you so much, and thank you for taking time out of your day. You can find Matt's article, AAII Groups in Facebook, Setting Your Privacy Options, in the May 2021 AAII Journal, and many others like it. Hope you have a great day.
If you liked our show, please visit aaii.com/webinars to register for more great webinar and video content. You can like us on Facebook and follow us on Twitter at AAII_invest_ED. For more investing education, check out our website, AAII.com. I want to thank our guests, Derek Hageman, Karen Kamenier, and Matt Bykowski. And of course, my co-host and co-producer, Kyler Worth. And you all for listening. We'll see you next time.